All right. Welcome and good evening, everybody, to Finance 333. This is week two. You made it through week one. Congratulations. Victor, thank you for being here for the live session tonight. Appreciate you. Make sure if you've got any questions, you just type them in so we can get you some answers. Anything you're probably wondering, your classmates are probably wondering those things too. So it's great to have you here. Appreciate your participation and make sure and ask any questions or concerns that might come up. Since you're here, Victor, any questions or concerns before we get started about week one, before we dive into kind of the agenda for this evening? Okay. All right. He's in good shape. Well, once again, thanks for being here. And I've made it through some of the grading through week one, and we'll complete out the grading this evening for the rest of the coursework from week one. So should have some scores and all of your scores by tomorrow. So if you turned in something on time and don't see a score, that's when you zip me a quick email or text so we can make sure and get you caught up. Also, appreciate those of you who, when you have concerns or questions about the assessment questions or about the checkpoint questions, that you'll just be in touch with me. Sometimes they're poorly constructed as far as the questions, and they're confusing as far as the answers. And so if that's the case, I like to get that feedback so that we can potentially look at changing that for the next course, for the next mod, or just, use it as an opportunity to talk through why it is what it is, right? So that could be a learning experience as well. All right, so for tonight, we got a couple things we need to do. First of all, we need to recap last week briefly. We need to talk about the course week for this week. We need to talk about bond investing and how we value bonds, and also mutual funds. And of course, we lump with mutual funds, ETFs, exchange traded funds, which are actually becoming more popular as far as new inflows than mutual funds are. So ETFs are wildly popular, and we'll go ahead and talk through similarities between mutual funds and ETFs and what they are, as well as some key differences. Okay. And then, as always, we'll spend the last few minutes of class tonight talking about the test. This week's test has 20 questions, so it's a little bit more than we had in week one, and but more of the same format as far as multiple choice and then true false. Okay. All right. So as far as last week is concerned, we talked about primarily modern portfolio theory, efficient market theory, and behavioral finance. And you should have come away from week one understanding that efficient markets and behavioral finance are at odds with each other. Efficient markets was the theory of efficient markets was created many decades ago. Behavioral finance came into being over the last few decades and really has come into play or has come into being because of the fact that efficient markets don't explain the anomalies and interesting things that happen in the investment market. They don't explain it perfectly. They do. Efficient market theory is what the basis was the basis for modern portfolio theory, and modern portfolio theory is really what investment advisors like myself and the software that we use to create portfolios has used as the basis for creating a well-allocated, diversified portfolio over the past 60 years. Behavioral finance helps us to explain why at times these models that we create for efficient markets and modern portfolio theory don't work. They're not perfect. They're not perfect because people don't necessarily act like efficient market theory assumes that they act, meaning that they have all the information available to them and they react immediately to information that's disseminated about the various companies that they invest in. Okay, and just another anecdotal thing, and I mentioned this I think on the board last week. Investors like Warren Buffett would not have the billions of dollars of value that they have as investors if it were not for something else going on in the markets, not just efficient markets. If it was only about efficient markets, somebody like Warren Buffett would have just gotten market returns over the past 50 years, because there's no way to do better than that if you truly believe in efficient markets. But there was something else going on over the last 50 years that allowed Warren Buffett to amass a net worth of over 60 billion, and that is that he was able to take advantage of people's emotions and the fact that people invest emotionally at times and give him opportunities that wouldn't normally exist, some anomalies in pricing because of the emotional investing that goes on in the marketplace. Okay. All right, so that's a little bit of a recap from last week. If you have any questions or concerns or something that kind of stumped you or just doesn't make sense, I'd encourage you to get in touch with me or the learning coach this week and be able to hash that out so that you just have a basic understanding of as I mentioned, modern portfolio theory, efficient market theory, and then also behavioral finance. Okay, some of the aspects of behavioral finance. Also, would have helped you with last week's test, as there were, I think, about half the test was on, behavioral finance principles, basically, in efficient markets. Okay, so that was a little bit about last week. This week, we're going to have a discussion board about bonds and bond valuations, specifically about yield curves. And I hope that this week's discussion board is as lively and has as many comments as last week. That was excellent participation on most of your parts. So I appreciate that. Hopefully you'll be diligent this week as well. And we'll have a good discussion about how bonds are evaluated, how we come to a price on a bond, and also about yield curves and what yield curves are as it pertains to bonds and bond investing. Okay, so that's this week's discussion board. As far as the assignment this week, we've got a question. Let me just see if I can pull it up here real quick. It's a case study, actually. Guess I've got to get out of that. All right, sorry, one sec. So it's 12.2, which is an end of chapter case study question. I'm going to pull it up right now for you to see. The writing's probably a little bit too small, but Victor, can you see a Word doc that basically starts with Calvin Jacobs? Are you able to see that? Okay. So this is it. There are just 4 questions, A, B, C, D, short answer questions at the end of a case study. And basically, you're going to be discussing some suitable mutual funds for this Calvin Jacobs individual after analyzing or at least reviewing and thinking about his situation. So you read about his situation in the case study and then determine the answers to those short answer questions at the end. Now, again, we talked about this last week in the session, but we'll talk about it again this week, and that is the assignment might ask for 3 to 5 pages again, and answering 4 questions that are basically short answer questions and trying to take up 3 to 5 pages is a little much. Having said that, I'd like you to at least get to a few pages and try to be as comprehensive with your answers as possible. Okay, if you're trying to get full credit, be comprehensive with your answers, answer in full sentences, try to look to the text, the chapter, specifically this week, chapter 12 for this assignment, and make sure that you're giving enough information so that I can give you full credit. If they're just part answers, very short answers, I'm not going to be able to give you full credit. Even if they're correct, I can't give you full credit because the instructions are specifically asking you to add detail, add content, demonstrate that you've actually read the chapter, and then you'll be in great shape. Okay? And if you're concerned about making sure that you're comprehensive enough, just make sure and get to that 3 pages of writing. Or, as I mentioned, just make sure that you're fully answering each one of these questions as part of this case study. Okay? Victor, any questions on the case study for this week? Just read through the case study, gives you the details of the situation, and then answer the questions, but make sure you're answering the questions in full thoughts and sentences, not just, one-word answers. Okay? Okay, rolling right along. Pretty straightforward, but as I mentioned, the most important part of this week's assignment will be to review the chapter. okay? Because if you read chapter 12, pay attention to chapter 12, you'll be in great shape. All right, so now back to the slides for chapter 11. As I mentioned, we're going to be talking about bonds and analyzing bond value. And then we'll spend about half the time talking about mutual funds and ETFs, after which, spend the last about 5 minutes talking about the test for this week, which is a little bit longer than last week, as we mentioned, because it's a midterm assessment. All right. So when we talk about bonds, what are we talking about? First of all, let's just back up and give you, review a definition of what a bond is. A bond can be used, the word bond can be used synonymously with debt, can be used synonymously with fixed income. So when we talk about debt or bonds or fixed income, usually we're talking about the exact same thing, okay? So what is a bond? What is fixed income? What is debt? Debt, fixed income, or bonds they're all a financial instrument that is basically an obligation between two entities or individuals. So that's in its most simple form what a bond or debt or fixed income is. The thing that is unique to fixed income or bonds or debt is that there's a period of maturity or a guarantee period of payback. Okay, there are always terms for payback, and then there are usually always terms, with some exceptions, but there are usually always terms for interest or for the cost of allowing that money to be borrowed. So in the case of a bank, they allow us to borrow money for them for something like a car or on a credit card for purchases or to buy a home. And that's all a debt. That's all a bond, okay, between a bond or a promise or obligation between two parties, right? An individual and an institution. The institution's basically saying, yeah, we'll give you the money. And in return for that money, we're going to have you promise that you will pay us back within a certain amount of time and pay us back interest, right? Because we're not in the business of letting people borrow our money and use our money for free. So that cost of us using their money is called interest. Now, governments and individuals and companies and local governments all use bonds, okay, as a means to operate, the things that they're doing, okay? They borrow money, not just, and a lot of times not in the traditional sense where you walk into a bank and try to get a loan, but in a non-traditional sense where they actually issue what's called a bond. They guarantee us that they're going to pay us back over time, and then we as investors invest in that bond, not only to get our money back after a certain amount of time, but more importantly, to get some amount of interest or some amount of income along the way. Okay, so and this is pretty oversimplified, but basically just remember, bond, debt, fixed income can all be used synonymously. They all mean the same thing. Okay, they can be used interchangeably, and also that a bond is an obligation between two parties for repayment over time, and there has to be some form of interest or dividend or payment of some kind of fee in order for somebody to be willing or a party to be willing to allow another party to use their money. So in the case of Walmart, if Walmart wants to build a bunch of new stores in China but doesn't have enough money on their balance sheet to do it, they might go out and issue a bond, raise billions of dollars through investors, and those investors are investing in Walmart with the idea that Walmart is promising to pay them back within a certain amount of time. Usually with corporate bonds, it's 20 years. And in the meantime, they're going to get paid some form of interest, some guaranteed amount of interest usually it's a semi-annual or annual basis. Okay, that would be a bond with Walmart. You may have seen bonds that show up on your local ballot box. So when you go to vote for a politician, there might also be a bond. That's your local community or state asking for permission from the voting public in order to borrow money to raise funds through a bond in order for a specific project to take place. So for example, if it's a school bond, that's the government asking for funds to be able to raise money to maybe build a new school. If it's a bond for parks and recreation, it might be for a museum or for a rec center or a new park. These are all things that many local government entities don't have enough money to pay for up front, but what they'll do is they'll allow you and I, the public, to vote. And if the bond passes, then they're able to then create a contract with investors where investors will get paid back over time with interest. And in return, they'll give them their money to the entity so that they can build whatever it is that they're bonding for. Okay? Any questions, Victor, about just the basics of what a bond is, or what debt or fixed income is? You're like dead asleep. Bonds are not the most exciting thing in the world. Some countries, that's a great question, Victor. Some countries actually aren't able to issue bonds. So most countries do. They're called sovereign bonds, and most countries in the world issue bonds. And it's because they are trying to raise capital, right, to do whatever projects they have to do. So, for example, here in the United States, we issue bonds as a federal government for about a third of all of our spending comes from bonds. So about 2/3 of our spending in the United States comes from tax revenue, right? But then we're spending about a third more than what we make from tax revenue, and so we bond for that. Okay. The problem is you've got a lot of countries that are either new or have a poor reputation or have an unstable government. And if those countries try to issue bonds, many times nobody will invest in them because they're not trusted, right? So if you're going to enter into a 10-year bond or a 20-year bond or a 30-year bond as an investment, you want to be able to trust whatever entity it is that you're investing in. And a lot of countries don't have a good track record when it comes to repaying their bonds, and so people aren't willing to invest. Brad, great question. Question is, why would companies issue bonds? Are there benefits to bonds instead of taking a loan? And the answer is yes, there can be significant benefits. A lot of times it's less costly to issue bonds if there are investors willing to invest than it would be to borrow that money from the bank. So for example, Apple, the iPhone maker Apple, and the computer maker Apple, a few years back issued a bond, and it was like 2.25% that they were promising to repay back over 10 or 15 or 20 years, which is a really, really low interest rate. And the reason they were able to do that is because people trust the company Apple so much because it's so financially strong and so highly rated that they were able to pay a very low interest rate. Well, if Apple would have tried to get the same, 20, 30, 40 billion dollars, whatever it was that they raised through a bank, especially one bank, they would have to pay that bank much more than 2.25% to get that loan. And Brad, a lot of banks probably wouldn't even be willing to give that size of a loan, right? So sometimes it's about the sheer amount that they're trying to get raised. Sometimes they just absolutely cannot do it through traditional, borrowing from banks. Yeah, so Victor, great question. There are actually resources online where you can look up for free the sovereign bond rating of every single country that issues bonds. And why would we care about that rating? Well, the highest rated countries, right, that issue bonds are going to be the ones that are most trusted, right? And then the ones that are the lowest rated ones are going to be the ones that have to pay a higher interest rate, which sounds nice, but they're not as trusted, right? They could default, what's called default on their bond. And if a country defaults, they just say they can't repay it, that's when investors get less than what they invested, right? So a recent example of that is Greece, right? Just a few years back, Greece was negotiating with bondholders, for their sovereign bondholders from their country debt, to try to get those bondholders to take less than what the bondholders had bought the bonds for because of the financial challenges that they were going through. Okay. And in fact, they did end up negotiating with a lot of the bonds and bondholders, and actually did negotiate lower than par, what's called par, which is the fair full price for those bonds. They did negotiate less than what those people had invested because of how, what a struggle they were going through. Brad, no worries. We haven't been going through very many questions on bonds yet, so you're welcome to shoot with anything. And welcome, and thank you for being here. Victor, great question. Did I answer your question as far as your ability to research online? So the solution to how you should invest in other countries, is that what you mean? So if you're going to invest in other countries' debt, the thing that I would do personally is I would invest in a good bond manager. And we're going to talk about ETFs and mutual funds here in a minute, but a good bond manager has a team of folks that can go and research those countries and make sure that their bonds are good before they invest in them. And so buying like an American Funds World Bond Fund or a Fidelity World Bond Fund or Vanguard World Bond Fund, that means you've got a team of professionals that have researched and done their due diligence on making sure that the bonds and the countries that they invest in are unlikely to default. Okay? So most of us don't go and do that research ourselves. Most of us can't even purchase those bonds ourselves because we don't have the right account or the right avenue to buy those bonds directly from other countries. But the way we can access them is through, like I say, ETFs or mutual funds, companies that actually are in the business of investing in bonds, and they package those bonds and sell them to us as investors. Okay? And then we can pick which one of those managers has the best track record over the past 5, 10, 20, 30 years and find which managers do a good job. And then we don't have to do as much due diligence for each of the countries that we're investing in. Okay? All right, and we'll talk more about advantages of mutual funds and ETFs, and that'll play right into what I just mentioned as far as an advantage of having that professional management. All right, so we have this term when it comes to investing called required return. And what is required return? Required return is the real rate of return of our investment plus a premium that we need to get for inflation, plus a premium that we need to get for risk. Okay. So the required return on an investment has to do with what we expect to get, right, from our investments. So let's say that's 3%. We need to get at least 3% from our investments. Plus, if we think inflation is going to be at 1% per year, then we need to get actually 4% because inflation is going to erode our value, right, by 1%. So we still need to get 3. So that means that if we think inflation is going to be 1, we've got to get a total of 4. And then if we think there's a risk of it going out of business, that company, there needs to be a risk premium, which means that we need to add in some form of return based on the risk that we're taking. So I could start with a real rate of return of 3%. That's my minimum. I expect inflation to be at 1, so I need at least 4 total. And then if I think it's a highly risky product, I might add another 2 or 3% in risk premium that I need to get. So I need to get about a 7% return, or I shouldn't even invest in that particular investment. Okay? So it's important as an investor, and institutions that invest are always evaluating this. What is their required return? And then you don't even invest in things that potentially pay less than that, right? Because you need to get what you need to get from your investment. You have an expectation, and you've got to get that expectation. So Brad, you mentioned what kinds of risk are involved with bonds. The primary risk is that the company or the government that we're investing in, right, that we're buying the bond from, will default. Because if they default, there's a high likelihood that that value of our bond could go to 0, right? Not as likely as a stock, right? Stocks go to 0 all the time. If you were to invest in 10 penny stocks today, 9 out of 10 of those would be at 0 within a year, okay? 0 value. High risk, high return potential when it comes to penny stocks, right? When it comes to bonds, the average default rates on bonds are very, very low, meaning there are very few defaults year to year in the grand scheme of things. There's trillions of dollars being traded in bonds around the world, and of that huge amount of money and volume of bonds, a very small percentage on an annual basis default. However, if you're unscrupulous and don't do your research, you could be investing in a bond that might default, right? So a few years ago, Lehman Brothers defaulted on their bonds. They were actually highly rated, so it's a pretty bad situation, right, during the financial crisis. And when Lehman Brothers defaulted, anybody holding Lehman Brothers bonds basically ended up with almost nothing. Okay, so default is your biggest risk. The more likely risk that you'll run into when it comes to bond investing has to do with where interest rates are going and the value of your bond is going. So let's talk about that real quick. And visually, let me show you. So here are the different kinds of bonds. You've got U.S. Treasury bonds, that's through the U.S. federal government. You've got municipal bonds, that's state and local governments. And you've got corporations like Walmart and others. These are all issuers of bonds. And we've talked about that. This visually is the most important risk issue associated with interest rates and bonds, excuse me. So Brad, when you talk about what should I worry about when it comes to bonds, here it is. We talked about default, but default is pretty unlikely, right? The more likely situation is that you'll have a circumstance where interest rates go up and the value of your bond will go down. So you pay $100 for your bond, interest rates go up, and you might have a bond that's only worth $85 or $90, okay? You might have lost money on it. Flip side is true though, bond prices go up when interest rates go down. So if I were to tell you based on looking at the visual that we're looking at here, Brad, if I were to ask you if over the last 30 years the general direction of interest rates has been down, interest rates have been going down over the last 30 years, what does that mean that bond prices have been doing over the past 30 years, generally speaking? Yes, perfect. Not hard, right? So this is a true statement. Generally speaking, interest rates in the US have generally had a trend of going down over the past 30 years. So from the 80s, okay, in the 80s, interest rates were really, really high, okay? High inflation, high interest rates back in the 80s. And then ever since then, if you look at a chart of the last 30, 35 years, generally speaking, bonds have gone down, interest rates have gone down, okay? So what does that mean? That means that in general, it has been a great environment to be a bond investor because the average price of the bonds that you've held over the past 30 years has generally gone up and done very well. Now, we're in kind of a different situation the last 3 or 4 years. The last 3 or 4 years, interest rates have basically been stuck going sideways at a very low level, right? So if we were to draw a chart, generally speaking, that chart would go down over the past 25, 30 years, and then the last 5 years, it would kind of go sideways until the last about 12 months, and interest rates have started to creep a little bit back up, not much. Mortgage rates, auto loans are still at all-time lows, okay? But the 10-year Treasury has started to creep back up, and short-term interest rates, which is what we hear about from Janet Yellen and the Fed. So whenever we hear about Janet Yellen and the Fed raising interest rates, that's what they're doing. They're raising short-term interest rates, which in turn should impact all interest rates and have a upward pressure on all interest rates as they continue to raise interest rates in the short term from the Fed, okay? So what does all this mean? What all this means is that if you're a bond investor right now, you need to be careful, right? Because generally speaking, you've been in a trend the past 30 years that's been very good for bonds. But now we might be entering a new environment where it might not be as good for bonds. Doesn't mean bonds have to go negative, doesn't mean you have to lose money. It just might mean that you might not do as well in bonds over the past 10, 15, 20 years as you did the last 30. Prime is actually based on these short-term interest rates that we're talking about from Janet Yellen and the Fed. Okay, so prime interest rate is the best rate that banks lend to each other, right? And that rate is based off of what the best rate that they get from the federal government is. Okay, so when Yellen raises interest rates, usually prime goes up, and LIBOR is another rate, short-term rate that a lot of things are based off of. But LIBOR and prime tend to go in lockstep, with what happens with short-term interest rates. So if you hear in the news that Janet Yellen raised interest rates a quarter point, which she did just a few months back, you'll also see that anything that you've got that's based on prime will eventually go up about a quarter point as well, okay, wherever it's at. Does that make sense, Brad? So if you want to know what's going to happen with prime, you're going to want to watch what's happening with Janet Yellen and the Fed, because the Fed is basically controlling the direction that interest rates go. And right now, Yellen is slowly raising interest rates, okay? Yes, a couple more times this year is what the expectation is. Now that we're already in August, though, I'd expect only one more raise this year. So originally, before the year started, Brad, people had projected that she might raise interest rates 4 or 5 times this year. She's only raised once, and the expectation is that she'll probably raise once more. So she's only raised a couple times this year. What you find, and let me go to this next slide because it illustrates this, is that when inflation is high, interest rates are usually raised. And when inflation is really low, interest rates go lower or stay low. Well, we're in kind of a weird predicament right now with the Fed because interest rates are at abnormally low right now, right? Like we talked about. And inflation is actually quite low as well. But there's pressure on Janet Yellen to raise interest rates even though inflation is low because unemployment is so good and the economy is doing quite well. So even though in a normal environment, most of the textbooks from years ago would say, okay, unless inflation is high, you don't raise interest rates on the Fed. Actually, Yellen is doing something that's kind of that breaks from the norm, right? The norm is you wait for inflation to go up and then you raise interest rates. Right now, inflation is very low, yet we're still raising interest rates to try to get them back to normal levels. And it's just because we went abnormally low after the financial crisis in 2008. So it was kind of an anomaly crisis, right? In 2008, we called the Great Recession. We reacted in a strange and unprecedented way to lower interest rates down to zero on the Fed. And now the Fed's trying to raise interest rates back to normal levels, even though inflation's not high, which is what normally happens. So abnormal on both sides of it, going down below where we normally go to try to help the economy after the Great Recession back in 2008. And now we're raising interest rates even though inflation's not that high right now. But if inflation were to tick up significantly, the Fed and Yellen would start to raise interest rates very quickly. All right, when it comes to yield, Victor, and I don't know exactly what you're getting to, but I'm going to take a stab at it and then you can clarify if you need to, but the yield and interest rates are actually always going to be inverse of each other, okay? So as interest rates go up, the yield starts to go up with interest rates. So right now, for example, many of the bonds that are newly issued are paying 2 or 3% right now. But as interest rates go up, then your yield will go up as well. Okay. Now, the actual price of your bond might go down. You might lose money on the value of your bond, but the actual income that you're receiving from your bonds might go up. Okay. Does that clarify? Interest rates go up, yields also go up. It's just that your actual total return goes down because the value of your bonds will go down as interest rates go up. Here's what I was describing over the past 30 years. You see that high point in the 80s, the early 80s with interest rates and inflation. And then you look over the last 30 years and basically the trajectory is downward, right? It's a downward sloping trajectory over the past 30 years with interest rates and inflation. It's fair to assume that at some point interest rates and inflation will probably go back up. Yes, Brad. So terms of a bond or debt or fixed income, which all mean the same thing, can be used interchangeably, debt, bonds, or fixed income. The terms are that you are paid back in full, your full principal, along with interest along the way. Okay? So if I get a $100 bond from Walmart, it's a 20-year bond, they promise to pay me back the $100 after 20 years, and they might promise to pay me 5% a year each year for the entire length of the bond, right, for all 20 years. Okay? And each company, each municipality, each government bond that's out there has its own set of rules, right? How much it's going to pay, when it's going to pay, how long before it matures, how long before they repay you. There's other provisions like call provisions where they can actually call it in early and pay you off early under certain bond covenants. So there's all kinds of different bonds, but on a very simple, level, a bond is an obligation to pay back a commitment over time, along with some interest or some kind of cost of allowing us to borrow that money. Okay? All right. Well, let me explain it this way, Brad, real quick, and then let's move to mutual funds for a second, so that we'll still have time to recover the test. But as far as bonds and price drops, if I pay, which usually when a bond is first issued, you pay par for it. And what does that mean? Par for a bond is usually $1,000 per bond. Okay. Now there are different bonds that have different amounts, but in corporate bonds and municipal bonds, it's usually $1,000 per bond. Now, if I pay $1,000 for that bond and interest rates today are 5%, so the bond pays me 5%, if interest rates go down, okay, if interest rates go down and next year going interest rates are only paying 3%, but I'm still sitting on this 5% bond, do you think people will pay more for my 5% bond or less for my 5% bond if the going interest rates right now are 3%? So what'll happen is if I can go to the bank and get 3%, but you've got a bond that pays me 5%, I'm actually willing to pay you more. Because if your interest rate on your bond is paying higher than what the going rate is, I'll pay you what's called a premium for the bond. Okay? If the other opposite is true, if I buy a bond and it pays me a 3% rate, and then interest rates go up and the going rate is 5% next year, they're going to pay me less, Brad, for that bond, because if they can get 5% at the bank, why would they pay me full value for my 3% bond? So what they do is they pay a discount for my bond. They pay less than what it's worth in order to make the effective yield on that, to make the effective yield on my bond the same as the going rate. So the reason that bonds go up and down based on what interest rates do is because at any given point, if we go to sell that bond, whatever people are going to pay whatever the going interest rate is. So if they have to pay more for it to get the going interest rate, then they will. If they have to pay less for it to get the going interest rate, then they will. And that's what affects the price of my bond. When interest rates go down, I get a higher price for my bond if I've got a bond that pays a higher interest rate, right, that I bought before. But as interest rates go up, I actually will get less money for my bond if I were to try to sell it. Okay. Now, if you were to buy a bond today, Brad, that's a 20-year bond and just wait for it to mature and you never sell it, you'll get back what you paid for it plus your interest, right? The only time that the values of bonds going down affects you is if you have to sell them before they mature, or if you're in a bond mutual fund where they've got lots of different maturities, because the value of those bonds in that mutual fund will go down, right, if interest rates go up, and you have no control over waiting until they all mature. The mutual fund manager has control. So if you buy your own bond, let's say I buy the City of Provo, which is the city I live in. If I buy a City of Provo bond, it's a 20-year bond, and I pay $1,000 for that bond, and they pay me 5%, they guarantee me 5%. The value of my bond might go up and down, but after 20 years, I'm going to get my $1,000 back from the city, and all along the way, I'm going to get my 5%. So maybe, Brad, what the confusion is might be that if you were to buy individual bonds and wait until maturity, you don't need to worry about the value going up and down based on interest rates. The only time you need to worry about that is if you were to try to sell them, okay? If you're going to try to sell them before maturity. That's right. If you liquidate before the end of maturity, you could lose value. Or if you're buying in a mutual fund, you could lose value because you don't get to control when the maturity is of all the bonds that they hold inside. There's going to be different maturities, right? So at any given point, when you get out of that fund, you could have less or more than what you paid for the bond fund. But if you buy an individual bond, just like you said, if you pay par price right when it's issued and wait all the way till maturity, as long as that company doesn't default or that government doesn't default, you're going to get all your money back plus interest. Okay? All right. So that's the basics on bonds. I'm not going to cover any more slides on bonds, so I hope that you'll read the chapter. I think it's an interesting chapter. It talks about yield curves, talks about interest rates on bonds. Coupons is what we call them, which is the interest that they pay. But I want to cover mutual funds for just a minute because all of us, and I say all of us, but most of us, I should say, will have access to mutual funds within our 401ks, IRAs, the types of investing that we're doing at any given point throughout our lives. So if I go work for a big company and they have a mutual fund 401k through Fidelity or Vanguard or T. Rowe Price or Principal, these are all big companies that people have 401ks through. If I work at Walmart, for example, I'll have a 401k through Merrill Lynch. Every single Walmart employee across the country that works a certain amount of hours has access to a Merrill Lynch 401k. Inside of that 401k, you can hold Walmart stock and you can also hold mutual funds. Okay, and this is fairly consistent with a lot of different retirement plans that you might have wherever you work. I just give Walmart as an example because out of a class of maybe 25 or 50 people, it seems like usually a handful have all worked at Walmart at some point. so they're familiar with this Merrill Lynch 401k that everybody's got that works there. The point is, mutual funds are an investment product that's been around for a long time. They started back in the 20s. In the 40s, there were only about 68 funds, but now there are thousands of mutual funds. Okay, thousands and thousands of mutual funds. And these thousands of mutual funds, there are more mutual funds, than all the stocks. There are about half of every household. So 1 in every 2 households that down your street probably have access to mutual funds or have mutual funds in a retirement plan of some kind or have investments where they've invested in mutual funds. So what is a mutual fund? Why do mutual funds exist? Mutual fund is a company, okay? A company runs a mutual fund, I should say, where they buy either stocks, bonds, or both stocks and bonds and create a diversified, professionally managed portfolio where you and I as investors can invest at lower amounts and get access to lots of different investments. So earlier tonight I said if you wanted to invest in other country bonds, one way to consider doing it is to buy a world bond fund through a mutual fund company. Why? Because it's hard and expensive for you and I as individuals to go out and buy bonds from certain countries. If I wanted to buy a Chilean bond today through Chile's government, I might be forced to first convert my money from dollars to the Chilean currency. Then I might have to pay a fee to buy into their bonds there. And then I might have to pay another fee to actually hold it in an account. Well, after all those fees, I might not make any money, right? So a way for me to get Chilean bonds without doing it that way is to buy a world bond fund or a bond fund that focuses on South America, for example. I'll have bonds from other countries as well, but at least I won't have to pay all those fees. So it's a much more cost-efficient way of doing most types of investing. Okay, most types of investing is more cost-efficient to become highly diversified and get professional management by using a mutual fund or an ETF. Okay, so what else can we talk about here? So why do people use mutual funds? We talk about diversification. One mutual fund might have 1,000 different stocks in it. For me to buy 1,000 different stocks, that would take a lot of transaction fees, right? And it would take a lot of money to make sure that could happen, to get shares of all those different companies. Where a mutual fund company, I can put $100 in and I've got a portion, okay, partial ownership in all those different companies that mutual fund owns. And so I get great diversification even though I only put $100 in. So that's one of the primary drivers of why people use mutual funds, is to get excellent diversification and at a very low cost. But in addition to that, they can get professional management. Most mutual funds are run by professional managers. We can look at their track records and get the best track record that we can find out there and choose that mutual fund manager. If a mutual fund manager does poorly, we can fire them and go find somebody else. We're not obligated to stay with them. We can invest at small amounts. We get service issues associated with it. It's very convenient. Okay, so this is the reason that mutual funds have become so popular. Some mutual funds have substantial transactional costs. They can have lower than market performance. So although there's lots of advantages potentially to mutual funds, there can be a lot of pitfalls, and you've just got to be careful to do some research, make sure that your fees are low, and make sure that your performance is good, right? And it's difficult to have low fees and good performance within mutual funds. Even though there are thousands of mutual funds, there are only hundreds that actually have reasonable fees and outperform the market. So the game becomes finding those mutual fund managers that do a great job, for a reasonable price, right? And with a little bit of research, you can screen for those at like a Yahoo Finance or Google Finance or Morningstar. There's lots of online tools that are free for you to be able to screen for good fund companies. Okay, so it's not impossible for you to do it, even if you're not an investment guru or investment professional. Let's see here. I want to talk about exchange traded funds. I mentioned to you that ETFs are now becoming more popular than mutual funds. It's not that there is more money in ETFs. There's still much more money in mutual funds, a lot more money, excuse me, in mutual funds. But mutual funds have been around for a very long time. ETFs have only been around for the last 10, 15 years. And so ETFs are coming onto the scene. They're usually less expensive. They usually have less management. So they're usually computer generated funds. And because they're computer generated, a lot of times they have very, very low costs. Because they're easy to get, they have low management fees, and they're highly diversified still. So they're still very diversified. ETFs have become very popular. In fact, in total flows the last couple of years, ETFs have rivaled mutual funds. So even though ETFs are newer, ETFs are getting more money in a lot of months that you evaluate the last couple of years than mutual funds are. So ETFs are worth looking at. A lot of times within a 401k, you only have access to mutual funds. But as time goes on, more and more ETFs are becoming available to people within their 401ks and retirement programs. And if you were to open an IRA with a Fidelity or Vanguard, you could easily get an ETF. It's very easy to get an ETF online with the online trading platforms that are out there. And as a financial advisor, I end up representing portfolios to clients all the time that have ETFs in them now to lower the costs associated with those plans. But once again, same idea as far as getting a basket of securities that's diversified, having access to a lot of different investments within a pool, right? It's a pooled investment without having to invest in each one of those separately and have all those transactional fees. But ETFs can have lower cost and they can be more flexible as far as when you can trade them. Mutual funds only trade once a day at the end of the day. ETFs can trade anytime you want throughout the day. So a little more convenient, a little lower cost, and it's no wonder that they're becoming more popular, right? And doing great in the industry. All right, I did want to get to ETFs, but we've run out of time for talking about mutual funds and how they work. Strongly encourage you to read Chapter 12, read it carefully so that you can do the assignment this week on the case study that we introduced to you at the beginning of the class tonight. Make sure that you're comprehensive and write full thoughts when it comes to your feedback on that case study so that I can give you full credit. You'll get a taste for how I grade, right, these assignments by the feedback that I give you on this week 1 assignment that you just did. And I'll have that back to you, as I mentioned to you, sometime tomorrow, if not tonight. And you'll be able to get kind of some feedback on, okay, so I turned in this amount of work and he gave me full credit because I, was comprehensive in how I answered and I answered the questions fully. Or I wrote a lot, but I didn't answer the questions fully, and so I didn't get full credit. So next time I know I don't necessarily need to write as much, but I do need to make sure and answer the question fully and demonstrate that I did read the chapter. Okay, so you'll get a sense for that based on this week 1 assignment that you'll have feedback on and a grade on, like I say, by sometime tomorrow. And then you'll be in great shape for that case study once you've read Chapter 12. But let's go ahead and move on. What I'm going to do now is take the last few minutes and talk about the test for this week. As I mentioned before, the test is a little bit longer because it's a midterm, right? So let me pull it up here, give you the topics that you'll see on the test. This week's test has 20 questions, as I mentioned before. Some of them are true-false, some of them are multiple choice. None of them are handwritten essays, which is probably consistent with other classes that you have, right? Not as many essays these days when it comes to these tests. Excuse me. Okay, so let's look at some of the questions that you need to know. All right, so you've got 20 questions. The first question is, It's a question that comes from last week's material. So again, because it's a midterm, you're going to have some questions that are kind of comprehensive from previous material. So 9, 10, 11, 12 in the book, chapters 9, 10, 11, 12 are all fair game for this test. But this question is asking, in efficient markets, so we're back to the efficient markets topic, how do you achieve high returns? How do you achieve high returns in an efficient market? So you need to know, how do you achieve high returns in an efficient market? It's not about researching individual stocks, right? Because in efficient markets, you don't have the theory of efficient markets is that all the information is already priced in, right? So how do you achieve high returns in an efficient market? What do you invest in? Okay, so that's number one. That's what you need to know for number one. So make sure and find that from the text. Number two, you want to make sure and understand efficient markets hypothesis again. What does efficient market hypothesis mean about trading? Okay, what does it mean about trading? And the answer is that efficient market hypothesis doesn't really care about trading. It doesn't really speak to trading. It speaks to information, right? So it's kind of a tricky question, but make sure if you get to number two and it's asking you about efficient markets and how they trade, just know that there's not an assumption about how they trade. So if I were you, I'd put false on number two, okay? You're doing good so far. You'll have 1 out of 2 right, whether or not you study or not, right? So number two is false. Efficient markets don't make any assumption about how things are traded. They make assumptions about information and how information is received and integrated into a price. Number three basically says, if you know a company's revenues and earnings, then the stock price is either predictable or unpredictable. So what do efficient markets say about the predictability of a stock price based on revenues and earnings? If you know that, you'll get number 3 right on the test. What do efficient markets say about the predictability of stock prices? Are they predictable or not? No matter what you know about a stock, is it predictable or not going forward? Efficient markets have something to say about that. If you know what they have to say, you'll get number 3 right on the test. Number 4 on the test. Number 4 on the test has to do with small companies. So you have small company stocks. We refer to them as small caps. And it asks you, does the higher return of small companies, is it all explained by the fact that they have higher risk? So is the reason that small companies have higher returns just because they have higher risk? Or is there something else involved? That, if you understand that question, then you'll get number 4 right. So what is it about small company? Are all of the returns of small companies just because they are more risky, or is there something else associated with that? Number 5 on the test is about the semi-strong form of efficient market hypothesis. Just make sure you understand what's going on with the semi-strong form of efficient market. We talked about weak form, semi-strong form, and strong form. Make sure you understand those 3 before you get to the test. Number 5 on the test. Number 6 on the test. You're going to want to understand what we talked about today about bonds. We showed you a graphic that talked about when interest rates go up, bond prices go down. When interest rates go down, bond prices go up. If you understand that relationship, you'll get number 6 right on the test. Number 7 on the test. Number 7 on the test asks you, what is the major risk associated with purchasing bonds? And Brad, you asked about that. I told you default is a major risk, but what question 7 on the test asks is, what about investment grade bonds? And investment grade bonds are the highest rated bonds. So there's very little to no default risk when you're talking about the highest rated bonds out there. So then I said, in reality, default's not that high of a risk when it comes to investing in highly rated bonds. But the biggest, most real risk associated with bonds is something to do with something else, right? And we talked about it for quite a while. So what is the risk to highly rated bonds? What's the major risk associated with highly rated bonds? It's not default because they're highly rated, but it's something else, and we talked about it tonight. Make sure you understand for number 8 the term debentures. Debentures, that's a bond term. So look in the text, what are debentures and what are they secured by? Number 9 on the test asks you what type of company would need the most cash for daily operations. What company would need the most cash for daily operations? And it's kind of a silly question. So basically on number 9, you just want to make sure and answer, sorry for the break. You just want to answer on number 9, who takes the most cash for daily operations? It's the company that has the largest, that's trying to manufacture the largest product. Just make a note of that. So if I'm building houses, it takes me a lot of cash reserves to build houses, right? If I'm selling Kool-Aid out front, that doesn't take a lot of cash. It takes a little bit of cash, right? But not a lot of cash. If I'm building houses or homes or planes or cars, those things take significant amounts of cash, right? So just keep that in mind. Just whatever answer on number 9 requires the most to actually build whatever it is that they're, whatever company whatever thing they're building, that's the one that requires the most cash, okay? So just have that in the notes. Number 10, what on a bond requires the issuer, the person who's issuing the bond, to retire portions of the bond before it matures? Okay, so what is it on a bond when you read in chapter 11? What function of a bond, what covenant on a bond requires the person issuing it or the entity issuing it to actually retire portions of the bond before it even matures? Okay, what is that called when they have to retire it before it matures? Number 11 asks, what is the real rate of interest? What's the real rate of interest? There's a formula, right? Just one thing minus another thing equals the real rate. So you've got a gross rate and then you've got a real rate. What's the real rate? Or you've got a nominal rate, excuse me, or a real rate. What's the definition of the real rate? How do you get to the real rate from the nominal rate? If you know that, then you'll get number 11 right on the test. Number 12 on the test, you'll need to know who you're going to get the highest interest rate from. The U.S. federal government, corporate bonds, or municipal bonds. Which one's the highest, which one's the lowest, and why is that? Okay. Why is one of them issuing lower rates than another? So we talked about how the higher something's rated, the lower the rate they give. So if I'm a AAA rated bond, I don't have to pay as much interest as somebody who's a single A bond because they're not as highly rated. If people don't trust you as much, you have to pay them higher interest. Okay. If they trust you more because you're highly rated, then you don't have to pay them as much interest. So that's one difference between types of bonds. So between the U.S. federal government and corporations, U.S. federal government pays us less interest because we trust the U.S. federal government a little bit more than we do most corporations, right? So that's one reason why U.S. government bonds pay a little bit less than corporate bonds. When it comes to municipal bonds, in general, we trust municipalities, but there's a key difference with the taxation of the interest. Federal bonds, okay, U.S. government bonds and U.S. corporate bonds are 100% taxable when they're paid. Municipal bonds give us income 100% tax-free, okay, federal tax-free. So with municipal bonds, they can pay less because our net return to you and I, because we don't have to pay taxes on them, is actually higher. Okay, so a lot of times municipal bonds will pay the lowest out of municipals, corporates, and U.S. treasuries because they pay tax-free income, because they pay us tax-free. Keep that in mind for 12, and you'll get that one right. Number 13, make sure you understand what the risk premium component of a bond interest rate is. What is the risk premium? Make sure you understand that the higher the bond's rating, like Moody's or Standard & Poor's rating, we just barely talked about this, then the lower its yield is, okay? The higher the rating, meaning the safer and more trusted the entity, the lower the yield. If you understand that, you'll get 14 right. Number 15, inflation and interest rates, how do they change relative to each other? And that's something in the bond chapter. How do inflation and interest rates change relative to each other? The answer is usually when inflation goes up, interest goes up. Usually when inflation goes down, interest goes down. Make sure on 16 you understand the pros and cons of mutual fund investing. We talked about those. We showed you some slides. You'll get that one right on 16 if you know the basic pros and cons of mutual fund investing. On 17, make sure you understand who acts as custodian on a mutual fund, on the mutual fund industry. So when you're reading in chapter 12, try to find where it says these are the types of companies that are usually acting as custodians for mutual fund companies. Okay, and you'll get number 17 right. Number 18, what does it mean to be a regulated investment company? What does it mean to be a regulated investment company for these mutual funds? Again, chapter 12. It's something to do with taxes. So what does it mean to be a regulated investment company? Number 19, make sure you understand what an open-end investment company is. So there are some slides on open-end investment companies, but it's because chapter 12 covers it. So just look at what the tenets of an open-end mutual fund company is. What is an open-end mutual fund company? And you'll get number 19 right. Number 20 is closed-end mutual funds. So what are the difference between open-end and closed-end mutual funds? If you know the basic differences, then you'll get 19 and 20 right on the test. Okay, those are the topics that you need to know for the test this week. If you've got a note, I've given you a handful of the answers that you need to know on those 20 questions, just in my explanations of the questions. But other than that, you've got topics that you can then go back to the book, chapters 11 and 12 primarily, but a little bit from 9 and 10, and go ahead and get the information that you need to get a great grade on the test this week. Any questions before we wrap up tonight? From you, Brad, from you, Victor, either one of you have any questions before we close it down, shut it down for the night? We've got college football coming up here pretty quick. We've got NFL football already started in the preseason. Got some pretty fun things coming up. Treasury bills, bonds, and notes are the three types, Brad, and it just has to do with the time frame. Bills are shorter term than bonds. Notes are even shorter term than bills. So it just has to do with the length of maturity or time to maturity, but they're all treasury instruments issued by the federal government. Okay? All debt. That's exactly right. Yep. Okay. You all have a great night. And let me know if you get stuck on anything this week. Good luck to you, and we'll talk to you next week.